Hi students, today we are going to cover lecture 9, PowerPoint slide lecture 9 in this video lecture, and lecture 9 basically finishes up chapter 5 of your book. Now in our last lecture we talked about GDP, which was the first part of chapter 5, and then the latter portion of chapter 5 talks about inflation. We did talk a little bit about what inflation is and how we can calculate price index in the last lecture, but in this class we're going to look at it in more details. Okay, so as a quick refresher, what is inflation? Inflation is basically the increase in the price of goods and services over time. So over time, the price of pen can go up, the price of books can go up, the price of gas can go up. For instance, you have to spend more now to fill up your gas tank if you compare it with 20 years back, or if you compare 10 years back. Okay, or you pay more to buy a gallon of milk compared to 10 years back. Okay, or to even to get a haircut. And this increase in price over the years is known as inflation. And the opposite, if the price is decreasing over the years, then it's called deflation. Okay, and it's one of the major macroeconomic topics that always economists talk about. You will see economists talk about GDP, unemployment, inflation. So inflation is one of the major macroeconomic topics. And inflation basically reduces the purchasing power of consumers. This is a very important and strong sentence. When we say that, what does it mean? What it means is basically when the price of goods and services are increasing, that means our affordability is going down. If our income is not also increasing, that means our affordability is going down, right? Let's say your rent was $1,000 10 years back, but now your rent is $1,500. So definitely, if there has been no change in your income, what has happened? Your purchasing power or your affordability has gone down because prices over the years have gone up. So inflation will reduce your purchasing power. Now, nominal versus real, this is important. We can have nominal income versus real income. We can have nominal GDP versus real GDP. We can have other types of metrics, usually different types of incomes. Personal income, corporate income, or the economy's income such as GDP, we can express them either in terms of nominal or in terms of real. When we say nominal income or nominal GDP, what that means is that number, that nominal GDP or nominal income has not been adjusted for inflation. It is the raw number, whatever we get from whatever the data gives us, the raw number. So that's nominal. Whereas real GDP or real income is basically the number that has been adjusted for inflation, meaning the effect of inflation has been taken out, and this number is now ready to be compared with the other numbers or to the base year. Okay, so again, nominal income can be categorized either as nominal income or real income. GDP is a type of income, right? It is the national income, so it can be nominal GDP or real GDP. So nominal GDP is basically the one that is not adjusted for inflation, whereas real GDP is basically the income that has been adjusted for inflation to take out the impact of the change in price level. So last class we also saw that we use price index, a metric called price index, in order to take out the impact of inflation from GDP or income. Okay, so basically price index is a percentage number that shows the extent to which a price of a basket of goods and services has changed over a period of time. So the price index is basically a number, or basically it's a number that gives you a percentage. It's a percentage number that basically shows the extent by which the price of goods and services has changed over time, whether it's month or a quarter or year or over the years. So it's basically helps you to see by how much the price has changed over a period of time. Now, consumer price index. So last class we saw, in the last lecture we covered how to calculate price index, but that is a very basic type of price index. Okay, but price index can be refined further, and we usually use the refined terms, or we usually use the refined price indexes in order to take out the impact of inflation. And one of the most commonly used price index, or one of the most refined price index, is the consumer price index. Now there are other types of price index such as producer price index, industrial price index. For this class we will not look into those things. We are going to look at consumer price index because this is the most common one. You will hear it a lot in news, and if you're studying in other economics class you will hear it a lot. It is also known as CPI. The short version is called CPI. So basically the definition of consumer price index is basically it is a measure of the average change over time in prices paid by consumers for a market basket of consumer goods and services. Okay, again, it is a type of price index. Only thing is that it has been refined and it is specifically used for consumers. Okay, I wanna share the formula. It is a little bit tricky. So if I give you a formula, if I give you a problem to find out the CPI, then make sure you have the formula with you written, or you have the slide open. So because this is sometimes a little bit tricky to calculate. But again, the CPI is basically given by the summary, the summation of price in given year times quantity in base year divided by summation of price of base year times quantity in base year. Then the whole thing is multiplied by 100 because this is a percentage that shows an extent, so we need to multiply it by 100. Now again, this formula, if you look at this equation, you will probably be a little bit confused of what's going on here, but I'm gonna go ahead and do an example so it's very clear to you guys how you can calculate it. But again, if you keep this formula in front of you when you are trying to solve something in your homework or in your exam, it will really help. So let's move and look at or focus or do an example of this. Okay, so let's say we are trying to calculate CPI calculation. Okay, and let's say you are given with a table. Okay, and this is how the table looks like. There are three types of good: laptops, then you have books, and you have pens. Okay, so when we say we look at a basket of goods, that's what we're doing. In our basket of goods, we have taken or we have selected these three goods. Now for whatever reasons, let's say we are looking at a particular type of, let's say we are looking at the education sector, that's why we took these items. But again, this is your basket of goods: laptops, books, and pens. And then you're given with year one information and year one quantity and price. So in year one we have one laptop for $700. Okay, one laptop was purchased for $700. In year two, two books were purchased for $100 in year one. And then in pens, five pens were in year one, 5 pens were sold for $20 each. Let's just say this is an example. Okay, then you're also given with year two information, because again we have to look it over the years, right? That's what the definition of price of inflation is and CPI is. We look at, when we are calculating the consumer price index, we are looking at the percentage number that changes, that shows us the extent of the change over time. Okay, so what's happening from year one to year two in terms of price? That's what we're trying to find out. That's what we're trying to find out in terms of the index. Okay, and let's say in year two, again we have quantity here, we have price here. So for laptop we still have one, but now the price has gone up to 750 because of inflation. And then in year two, now quantity is more and price has also gone up. For books, 170. Year three, we have 7 quantity has gone up and price has also gone up to $50. So that's what we are given with. Okay, we are also given that year one is your base year. So these information are given to you. Okay, So I have already given you this information. Now I will start asking you the questions. Okay, so first question based on this table. What is nominal GDP? Okay, and GDP, this is basically GDP. We are trying to calculate GDP. Okay, so what is nominal GDP in year 1 and year 2? So there will be these are two separate questions. Why we are trying to find out the nominal GDP in year 1 and we are trying to find out the nominal GDP in year 2. The way we do that is, first we focus on year 1 and nominal GDP. Remember, this is the raw number. We do not consider inflation or price index in case of nominal GDP. Okay, so it's pretty simple. Nominal GDP is given by, for year 1, nominal GDP, okay, is gonna be this number times this. So 1 times 700 plus this number times the price. So it's price times quantity. Oopsie, I'm sorry about that. Oh man, there you go. So it's price times quantity. So here we do 2 times 100, and then we look at pence because we are given with these goods in the basket. 5 times 20. Okay, and we end up with 700 plus 200 plus 100, which is $1,000. So the nominal GDP in year 1 is $1,000. Okay, then we calculate the nominal GDP in year 2. Okay, same way, we will use the same formula to calculate what we did here, but we're just going to use these numbers now. Okay, so price times quantity plus price times quantity plus price times quantity. So 1 times 750. So 1 times 750 plus 3 times 170 plus 7 times 50. Okay, and if we do that, we basically end up with 750 plus 510 plus 350, which is equals to 1610. So that's the nominal GDP in year 2. Okay, now if we do not consider inflation in general, what we are going to say about the GDP, how did it change from year 1 to year 2? So we then compare this number to this number, and we see that the GDP has gone up by $610, which is fantastic, which is good. You know, my GDP has gone up pretty high, and that's a good sign. However, this is not the proper way to compare it. Okay, while this number is right, the nominal GDP, because in the base year there is no change in price level, so we do not have to adjust the base year for price. This is base year, so no need to adjust the base year for price index using price index. So make sure you know that in the base year we never have to adjust that for price index. Okay, whatever the raw number is the correct number, because we start off with that point. But this number over the years has gone up, but price has also gone up, right? So we have to take out the impact of inflation from this number so we can compare it with the base number. We can make proper comparisons, because here this is overestimated. We did not take out the impact of inflation from it. So how do we do that? In order to do that, we have to calculate the CPI. Okay, so my next question will be, what is the CPI in year 2? Again, year 1 we don't need to adjust because year 1 is the base year. So what is your CPI, or consumer price index? Now if we go back to the slide, that's the formula: summation of price in given year times quantity in base year divided by price in given year times quantity in base year multiplied by 100. So in other words, the CPI is given by summation of price in given year times quantity in base year. When I get confused with it sometimes, so make sure you write it out. Base year divided by price, I'm sorry about that, divided by price in base year multiplied by quantity in base year. Now, and this whole thing is multiplied by 100 because this is a percentage. So we now know this formula. So what we are going to do is we are first going to calculate the numerator. First we will calculate this, then we are going to calculate this, and then we are going to put those numbers together. In that way it is very easier to calculate. Okay, so let's first look at the numerator part, where we look at price in given year times quantity in given year. So price, if you scroll up, you will see the price for laptop in the given year, which is in this case year 2 is the given year. Okay, so given year is year 2. This is your given year, and base year is year 1 because I told you base year is year 1 and given year is year 2. So in this case, price in given year for laptop times quantity in given year. So price in given year multiplied by quantity in given year. Same thing for books. We take price in given year times quantity in base year. Again, price in given year for pens times quantity in base year, and then we add these because that's the summation. That's what we're trying to do, right? So let's go back and calculate the numerator. Okay, so we know for laptops it's 750 times 1. Okay, for laptops. Then we have 170 price times 2 is the quantity, plus we have 50 times 5. See, these are the price in the given years, whereas these are the quantities in the base year. So that's the trickiest part. You have to look at the equation and then calculate it. And if you do that, we end up with 750 plus 340 plus 250, which is equals to 1350. Okay, so now we have the top part. Okay, we have the top part. Now we will focus on the denominator part, which is price in base year times quantity in base year. Now look at this. This is something you already calculated, right? What did you do here? Price in given nominal GDP in year 1 is the same thing as what we have in the GDP. Price in given year, price in given year times quantity in given year, price in given year, price quantity in given year, price in given year plus times quantity in given year, and we do a summation of these three. So that's what it is. That's what the denominator is. So we already know the denominator is, we already calculated, so that's easy for us. So the denominator is basically the nominal GDP of base year or year 1, and that's equals to, we calculated it to be $1,000. Okay, now let's calculate the CPI. We know the numerator, we know the denominator. So 1350 divided by 1000 times 100, and we end up, I'm sorry, this should be 1340 actually. Yeah, I made a mistake. So this is 1340 divided by 1000 times 100, that's equals to 134. That is your CPI. And if you remember, if I tell you what is the inflation from last class, you know inflation is given by price index minus 100, and in this case your price index is 134 minus 100, which is equal to 34%. So this means for this basket of goods from year 1 to year 2, the prices have gone up by 34%. So that's a pretty big jump, okay? And then that's why we have to adjust this nominal GDP in year 2 using the price index. So now we have calculated the price index, which is 134, right, which is 134. Now we need to, my next question, my final question from this will be, what is your real GDP in year 2? Now again, in year 1 we don't have to calculate real GDP, because in year 1 it is the base year, and in base year real GDP is equals to your nominal GDP. So we do not have to adjust for inflation because that's the starting point, but we have to calculate the real GDP in year 2. And how do we calculate that? The formula to calculate that is basically we do real GDP is equals to nominal GDP divided by CPI times 100. That's how we are going to calculate. And if we go, the nominal GDP in year 2 is 1610. You calculated that, you saw that. Okay, 1610, and we know the CPI is 134. Then we multiply this by 100, and the number that we get is, let me calculate that, 1610 divided by 134 times 100, that's 1201. Now look at this number. It did go up from 1000. The nominal GDP in year 1 was 1000, but the nominal GDP in year 2 was 1610, right? And that was looking at that number, it seemed, oh wow, right? Because what we found out is this is our summary of results, right? Nominal GDP in year 1 is 1000, and that is also equals to your real GDP in year 1 because it's the base year. Okay, then nominal GDP in year 2 we calculated is 1610, and then real GDP in year 2, which is the actual number that we should compare, is 1201. So if we do not consider this number, and if we only compare this with this, we would say, oh wow, the GDP has gone up so much, we are doing so well. But in reality, we have to compare this number to this number, and that is the correct comparisons we are going to be doing, because this has been adjusted for inflation. Okay, so yes, it did go up from 1000 to 1201, which is good, but it did not go up as much as this. It went up by $201. So you know, it is a more accurate comparison and makes more sense. Okay, so that's how we are going to do it. We are going to calculate CPI, and then we are going to use the CPI using this formula to take out the impact of inflation and calculate the real income or real GDP. So I know this is a little bit complicated, but make sure you understand these steps. You might have a homework problem like this, so make sure you understand this, how to do that, and it will help you to calculate CPI, nominal GDP, real GDP, and take out the impact of inflation. Now inflation, now the CPI, the way we calculate it, can also be used to take out the impact of changes in income, or take out the impact of inflation when income goes up over time. And how do we do that? We are going to do that. We're going to do a couple of more examples so this is crystal clear to you. And I know this is something new for you guys, so I want to make sure you understand this. So let's say again we are given with another example. Okay, let's say in 2013 your income, your annual income was $40,000. Okay, and in that year you're given with CPI of, you're already given with CPI, so you don't have to calculate CPI, which is a good thing. So in year 1 your CPI is given, in year 2, and then in 2014 your income went up to 44,000, but the CPI changed and it also went up to 202.6, which means that the prices have gone up over the years, so we need to take out the impact of inflation. Now in this example I do want to point out one thing. 2013 is not the base year, right? Because CPI is 197.4. In base year, CPI will always and always be equals to 100. Okay, so if you are looking at a base year, the CPI, the value of the CPI will always be 100, and then it starts going up over the years when the price changes. Okay, so based on that information we can tell in 2013 is not the base year, 2014 is also not the base year, and what we have to adjust both these income for inflation. Okay, and then my question based on this is, how much did your income go up from 13 to 14 in real terms? So that's what my question is. I am asking, how much did your income go up in real terms? Well, in nominally it went up by 4,000, right? 44,000 minus 40,000 is $4,000, but we have to consider the impact of price, and we are already given with the CPI, so we have to see, we have to calculate the real income, because this 40,000 is the nominal income in 13 and 14 is the nominal income in 14. Well, 44,000 is the nominal income in 2014. So we have to calculate the real income in both 13 and 14 and then see how much the income actually went up. Okay, so first step is to calculate real income in 13, and that is equals to 40,000, which is your nominal income, divided by the CPI, which is 197.4 times 100. Okay, and that is equals to, I believe, 20,263.4. Okay, so although literally you're receiving 40,000, but in real terms, when you are considering the inflation, your real income is actually $20,263.40. Okay, now we again have to calculate the real income in 2014, same way, so that we can make comparisons. Okay, so in your nominal income in 14 is 44,000, and your CPI in 2014 is 202.6 times 100, which is equals to 21717.6. So now when I ask, by how much did your real income go up from 13 to 14, the answer is now easy for you to calculate. So increase in real income is equals to 21717.6 minus 20263.4, which is equals to 1454.27. So your real increase in income is 1454.27, and this has been adjusted for inflation. I want to do another example very similar. Again, the reason I'm doing this is so that you guys are clear with this type of concept. I know it's again new and it will take a little bit of time, so I recommend you go over these examples a couple of times so it's pretty clear to you what's going on. So let's say we do another example. In 1991, your monthly salary was $5,000. Again, this is a new example, okay? So don't confuse it with the other one. Let me just take that out. You don't confuse it. Okay. Here you go. So you don't confuse it. So in 1991, the monthly salary was $5,000 and you are given that the CPI in 1991 is 136.2. So again, we know 1991 is not the base year, because if it was the base year, the CPI would be 100, but it's not. So we have to adjust this number for inflation. Remember this all the time. And then in 2001, your CPI is given equals to 177.1, and that's it. That is the information you're given. Now my question is, what is your equivalent income, or what is your equivalent monthly salary in 2001? Okay, so basically what I'm saying is, now in 1991 your salary was $5,000 and we have to, this is a nominal income, we have to convert it into real income, and then what is equivalent to that real income? Okay, so the question can be tricky, but in reality we use the same formula. So first we try to calculate this. So nominal real income in 1991, that is equals to 5,000 divided by 136.2 times 100. Okay, now I am saying, what is the income that is equivalent to this in 2001? So what we can do is we just keep this as 5,000 divided by 136.2 times 100, which is equals to X. We don't know the nominal income in 2001, which we're trying to find out, but we do know the CPI in 2001, which is 177.1 times 100. So now we have to calculate this X by crisscrossing, and the final value that we get for X is basically $6,500. What it means is, in order to maintain your purchasing power from 1991 to 2001, you have to earn $6,500. So if you earn $6,500 in 2001, that means you have the same purchasing power as you had in 1991 for $5,000. Okay, now if you earn, let's say you earn $6,200 in 2001. What does that mean? That means your purchasing power went down. Okay, because now you're earning less than 6,500, which is not equivalent to 5,000. So your purchasing power actually went down. Although in when you see it by eyes, 6,200 is more than $5,000, but when we calculate it in real terms, it is actually less than $5,000 in real terms. Okay, and if you earn more than $6,500, that means your purchasing power has went up. Okay, so we now continue. We are done, pretty much done with inflation. Now we look into the next type of income account, or next type of method to calculate national income, and that is called social accounts. So basically, the GDP is one way to calculate national income. Then we have GNP, GNI, other ways to calculate social total national income of the economy. And social account is basically another accounting method to keep track of the national income. Okay, in this approach, the major economic accounts are described. We use major economic accounts, and then we usually start with the GDP. So at the very top we will have GDP, and then we make several calculations, and then we end up, the final number that we end up with is called the disposable income for individuals. Okay, and the social income basically measures the well-being of a nation's economy based on allocation of resources by society. So the number, or the number that we get from social account is basically helps us to understand the well-being of the national economy based on the allocation of the resource by the society. I just want to do a quick run through of how the national income is maintained or calculated or recorded under social accounts, and it's like a table. Again, I will not ask you to do a calculation for social accounts, and this is for your knowledge. So just to know what are the important accounts, because I might ask you what are some of the important accounts that we use in social accounting, okay, method, or what are the information we can get from social accounting. Okay, so that's the reason why I'm doing, or how why I'm doing how a social account looks like. Okay, and then if you remember from the slide, we start with the GDP. Okay, then we take out depreciation. The first part we take out depreciation, then we end up with NDP. Okay, from NDP we take out three other things. We take out NFFI, actually two other things, NFFI, and we also take out indirect business taxes. And that's what I'm doing. We are taking out, that's why I'm doing subtracting. We end up with national income. Again, if you remember the form, when we add indirect business taxes, NFFI, national income, and depreciation, we end up with GDP under the income approach. Whereas in the social account, we start with GDP, we take out depreciation to get NDP, then from NDP we subtract NFFI and indirect business taxes to get national income. Now from national income we will do two things. We will subtract income that's earned but not received. Now what can be an example of this? Income that is earned but not received. So any type of taxes we pay on the income, those are, we earned the income but we are paying those away as taxes to the government, so those do not come to us, we do not receive that, right? So we subtract all these numbers, and these items that are included under these are corporate tax, social security tax, or we also subtract undistributed corporate profit. If a company makes profit and the people are not taking the profit and leaves it with the company, then that has not been received by the people, so we still keep it with the company. So we subtract these from national income, and we add another item, which is income not earned. You did not work to receive this income, but you received it. So what is the meaning of that? What can be an example of that? It's an income that you received, but you actually did not work for this income. This is something you automatically received. So what can be an example of this? An example of this is welfare services such as social security benefit. Okay, so, or unemployment benefit. These are income that we have received but we did not earn it. Okay, so we add these numbers to the national income, and when we do that we end up with personal income. Okay, then we take out the personal income taxes from minus personal income tax, and finally we end up with the last number, which is called disposable income. And that's what we said in the slide. We start with the GDP and we will end, the last account that we have in a social account system is the disposable income account. Okay, now from what type of information we can obtain. So these are the first, let me tell you, these are the different types of accounts, economic accounts, that we use in a social accounting system. Personal income, personal income tax, then national income, NDP, GDP, depreciation. These are the different economic accounts that we are using to keep track of the national income under the social account system. Now another question I can ask is, what are the types of information that we can obtain from social accounts? We can obtain disposable income for each individual from this type of system, and from here, when you have income, what can you do with it? You can either spend it or you can save it. So from here we can also get information about what your consumption is, which is say spending, or we can also get information about savings. Okay, so these are some of the information we get: disposable income, what is your consumption, what is your savings, how much money you're saving, how much income you're saving, and how much income you're spending. This type of information can be obtained from the social accounts, and that is why the social account is very important. So make sure you remember this. Again, you don't have to know the order the economic accounts go over, but you just have to know what type of economic accounts are used in this and what type of information we can obtain under social accounts. So moving on, the last topic in this chapter is basically this chapter talks about the disadvantages of GDP. Okay, now we looked at the beginning of this class what is GDP, how we calculated it, what is included and what is not included in GDP, and how it is the most important national income accounting method used worldwide to keep track of the national income. Now, but even though it is most popular, there are some shortcomings of GDP. So what are those? What are those disadvantages? Okay, first one is the quantity of goods and services produced is only a partial representation of the standard of living. Okay, so if you remember, how do we calculate GDP? When we calculate the GDP, we did price times quantity. Okay, so if you produce more quantity, your GDP goes up. So what this is saying is basically increase in quantity does not necessarily mean that your standard of living has actually gone up. Well, yeah, it is a sign that you're producing more, so that's good, but it's not necessarily a good sign. It's just a partial representation of standard of living. There are other factors that give us more information of standard of living. So increase in quantity gives us only partial representation of standard of living. Okay, then second disadvantage is it does not consider any byproducts. Okay, by byproducts I mean, like, if you're trying to produce a good and in the process you release other harmful products, or you release other good products for the society, and those are not taken into account in GDP. For instance, let's say if you buy a car and you are driving it, the purchase of the car will be included, but the pollution that you're creating for the car will not be accounted for in the GDP. So negative externality or negative spill, or positive externality or positive spills are not accounted for in the GDP. The third disadvantage of GDP is amount of leisure for individual is an important social welfare or sign of standard of living, and that is not accounted for in GDP. Amount of leisure means how much vacation time you have, how much time you have to relax and spend some smooth time without much work, so, or vacation time, and that is one indicator of social welfare, or an indicator of a standard of living, because when you become rich, you probably have more money to go to expensive vacations, you have more time to take off from your work, so that is a sign of standard of living, right? But that is not accounted for in GDP. The fourth disadvantage is, again, it says GDP does not consider the quality of products, it only considers the quantity. And that's what we were saying in the first disadvantage, that quantity is only a partial representation of standard of living. We also have to look into quality. If the quality of the products has gone up over the years, doesn't mean that I'm producing a old-fashioned pen and I was used to produce 10, now I'm producing 20. That doesn't mean the standard of living has really gone up, right? If I'm producing more advanced pens after 10 years, then the quality has improved, and that makes a difference, right? But GDP does not consider the quality of products. Another example would be, in today's world, let's say cars are much more advanced than they were 20 years back, right? They are more fuel efficient, they have more features and more qualities, but these are not taken into account in GDP. That the car, this car technology has improved so much over the 20 years, but we have only looked into the quantity, we have not focused on the quality. Okay, and then the fifth disadvantage of GDP is it does not account for productivity. which we cannot measure. There are certain jobs that we cannot calculate the productivity, or we cannot put a value on those, or we cannot put a salary or wage on those type of jobs. And the example would be, maintaining a household, cleaning a home, or making home repairs, cooking food. These are all productive works, but we do not get paid for it, right? So they are not accounted for in the GDP. And finally, the last disadvantage of GDP is that unreported economic activities are not included in GDP. Now, let's say people working with cash, they don't report their income to the IRS in order to avoid taxes. So we do not know about those income, and therefore that's not included in GDP. Or you can have an underground economy like the drug market, where they sell drug and make profit, but we don't know about that, because if we do, then cops will come and get them. But those are not reported in the GDP. So sometimes the GDP, although being one of the most common used metrics, sometimes it can have disadvantages, and sometimes these advantages can make the GDP overestimate the number, or sometimes the GDP can be an underestimated number, depending on what factors are not included. But with that, this chapter is over. So that is the end of chapter 5 and lecture 9, and also the end of this video lecture. So in our next video lecture, I will cover chapter 6, or I will start talking about chapter 6. Until then, you guys stay safe, and I will be back soon. Bye.